This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Welcome to Escala Partners Investment Perspectives. Liberation Day has come and gone, but it didn't feel that liberating. Equity markets fell rapidly. Economists increased the chances of a recession, and yet bond yields rose, reflecting a loss of confidence in the US. And despite a 90-day tariff pause and talk of deals, uncertainty remains extremely high. So today, we thought we'd focus on three topics. Firstly, is this time different? And secondly, what are our fund managers saying? And finally, how are we adjusting portfolios? And of course, to provide the insight into these topics is our Chief Investment Officer, Tracey McNaughton. Welcome, Tracey.
Hello, Ed.
Tracey, let's start with how you're viewing current events in markets.
Well, yes, it's very hard. Some liken the current episode to COVID for its lack of transparency. If you can recall, in COVID, it felt like it was a fog that had descended that only really began to clear as progress was made on the vaccines. A similar sort of fog, I think, is hanging over this market. The way that I am viewing it all is through three layers that are time variant. So the first layer is where we have uncertainty and volatility. This is the initial layer as we try and understand and digest the tariff announcements. The market has begun to price this in since February 1st. That was effectively the first announcement of tariffs on Canada and Mexico. US equities are down 13%. As time moves on, we get to the second layer where the tariffs start to impact fundamentals, growth, inflation, and earnings. And the market has not begun to price this yet. There is still some fog around this layer. Early data on manufacturing activity in the US suggests the worst conditions for manufacturing since 2001, when the survey began. But the data is still coming through. And then the third layer is the lasting impact of the trade war. This certainly hasn't been priced yet by the market, so we'll wait for that. Time is the enemy. The longer this draconian trade policy lasts, the greater ultimately is the price that investors will demand to invest in or fund the US. That price translates into a combination of a discounted share market, a weaker US dollar, and or higher bond yields.
Tracey, you mentioned the similarities with COVID in terms of uncertainty of what comes next, but how do you compare the market reaction this time to previous sell-offs?
Well, I think it's very different. The GFC was driven by risky lending into the housing market. Banks were in bad shape, but fortunately, government balance sheets were healthy. And so government stepped in and took ownership of a lot of banks. The government secured the system back then. The policy support mainly came from monetary policy that was big and globally coordinated. During COVID, the correction was due to the economy being put into an induced coma while the health authorities dealt with the pandemic. Again, the government secured the system. The policy support came in the form of huge fiscal handouts and dramatically lower interest rates. This time around, the correction was due to the government. This was self-inflicted. And so the question is, who is going to rescue us this time? Who is going to secure the system? The central banks, you may have noticed, Ed, are not running to cut interest rates this time as they did in 2008 and 2020. They're not doing that because the Trump trade policy is inflationary as well as being bad for economic growth. And so the decision to cut interest rates is just not clear. Governments could offer fiscal stimulus, But government budgets are pretty stretched after the COVID handouts. They haven't recovered from that. The longer the tariffs remain in place, the more they will hurt. In COVID, once the fog lifted, we just picked up where we left off. We were more juiced up, given the stimulus, but there was no lasting economic damage. That is less likely this time. Once we get through this fog, the general view is that things will be different. Growth will be weaker, inflation will be higher, earnings will be lower. It will be a different world. And so the share market needs to adjust to reflect that.
Tracey, one thing we as advisors always stress to clients is the level of oversight you and the team have over our approved funds. There's quarterly meetings at a minimum with ad hoc reviews if required. And it's particularly important at moments like this. Now, you've just come off Heat Week, where you talk to all our fund managers. What have they been saying?
Well, I've literally come out of a Heat Week meeting just now, Ed. More than just casting a shadow over the economy, our fund managers are saying we are in a different operating environment. I was a bit surprised by this. Normally, fund managers are very stoic, very staid. It takes a lot to shift their perspective. Our most staid manager warned about broader geopolitical instability arising from ongoing trade tensions. He talked about how easy it is to, quote, paint a very bearish view, saying that you could go to some dark places. There was frequent mention of the impact this would have on business investment. Companies aren't going to rush to build a new factory in the US because who knows what the landscape is going to look like in 5 years, let alone in 18 months when we have the midterm elections. Some also spoke about the likelihood of a more fragmented trading system now. This would be a world split into separate economic trading blocks rather than one integrated system. So this would be a regionalization model of trade. Countries in that sort of environment may be compelled to choose alliances. Ultimately, this is a suboptimal outcome. Previously, productivity and profitability were boosted significantly by globalization, enabling firms to outsource less profitable or lower value-added tasks, especially manufacturing, to lower cost countries like China. Well, going forward, companies will be less able to leverage global outsourcing, resulting in lower overall productivity growth. This is a new operating environment. We spoke about it a little in our annual agenda publication released earlier this year. The world is very quickly becoming more introverted, less trusting, and less open with each other. Investors need to think about how much they need to be rewarded now to invest into such an environment.
And so, Tracey, how have fund managers adjusted their portfolios?
Well, certainly for the most part, they have become more active. They were adjusting to a less business-friendly US even before April 2nd, since many have moved away from stocks that rely on growth, and they're now shifting their portfolios towards companies that are more higher dividend paying, they're more value biased stocks. One portfolio manager just in the meeting I just had, Ed, described it as a shift to a more boring portfolio, holding things like Colgate instead of, say, Nvidia. Many fund managers were finding better opportunities in Europe following the deal the German Chancellor did with the Greens to unlock additional fiscal spending there. The recent volatility in markets has spurred them even more to find opportunities outside of the US. Industries like defense, aerospace, financials, and companies linked to energy infrastructure. As a whole and as a general rule, Europe compared to the US is a more defensive market. All the big tech names tend to be out of the US. That's a growthier market. Europe tends to have the more boring, duller companies. And so it's not surprising fund managers are moving there to seek some shelter from all of this. Some have run the ruler over their holdings to determine which have most exposure to supply chain issues. Some companies have been sold because they have been very China-centric in their sourcing models. The other thing they did mostly before all of this was to move away from cyclical sectors and into more defensive sectors like healthcare, consumer staples, and utilities, because there were signs that the US economy was slowing before April 2, and so they were responding to that.
Tracey, on to our final topic now. How have you and the team adjusted portfolios?
Well, big regime shifts such as moving away from 80 years of free trade require asset allocation moves. We are choosing to be tactical at this stage, but if this proves to be a shift that lasts for longer than, say, 2 years, we would need to reconsider our strategic asset allocation. A possible scenario that may warrant us doing this could be that rising protectionism leads to nationalisation. It is possible we see the size of the publicly listed equity market shrink even further in this environment, and that would require us to rethink our allocation between public and private markets. It is obviously very early days for this, but we can see a scenario where domestic industries, once protected from international competition, become less dynamic, less productive, and increasingly require assistance from the government. I see what is happening right now with British Steel is really worth watching in this regard. British Steel is currently under Chinese ownership. As a business, it is struggling under the weight of two things: high energy costs, that makes production of steel very expensive, and overproduction due to China. The UK government is now considering nationalising the company after legislation passed the House of Commons that gives the government the power to instruct the company to keep the plant open. This, despite the company losing £700,000 per day. So why is the government so keen to protect this business? Because we are entering a new world where national self-sufficiency is becoming more important than comparative advantage. This creates an environment that tends to foster inefficient industries and companies. There's only one steelmaker left in the UK for a reason. It is expensive, and competition is intense from China. China produces over half of the world's steel because labour and energy costs are so low there. The labour cost to produce 1 tonne of steel in China is $10. In the UK, it's 20 times that. It's been a shrinking industry in the UK for obvious reasons. The UK government says it needs to protect the last remaining steel mill for national security reasons. They say it is a critical ingredient to just about everything: housing, railways, airports, of course. When protectionism rises, trust between global partners falls, and national security increasingly becomes a reason to protect domestic industries even more. Clearly, the economics for British Steel don't work in private hands. Losing £700,000 a day is not good. And so the government is more likely than not to nationalise it. It is possible we see a trend towards nationalisation as governments protect various industries that were not worth protecting when trade flowed more freely around the world. We saw a little bit of nationalisation come up during the GFC. Various banks were taken over by their governments, and the reasons then was systemically important. Progressively, those banks were sold back to the private sector. We could see something similar again, I think, Ed.
Do you think that the best way to approach this is through tactical asset allocation?
Yes, we do. We don't know what Trump's next move is going to be, but what we do know is that volatility and uncertainty have increased. So we made the decision to just step out. The waters have just become too choppy for us, so we're getting out for the time being. Not completely, but we do think it is prudent to build up a cushion in this environment. We would prefer to watch this from the shoreline and wait for things to calm down before dipping back in. We have a number of catalysts that we're watching out for as indicators to help guide us on when it's the right time to get back in. We are a long way from that, but we'll be watching the data closely. The kind of catalyst that we'll be watching for is mainly valuation and sentiment. We have a range of sentiment indicators that we're monitoring right now. Most of those indicators are in extreme bear territory, very pessimistic. We would want to see those sentiment indicators pull back to more normal levels before dipping back in. And we also need to see earnings expectations adjust lower.
Tracey, what about currency? The Aussie dollar has fallen a long way. Should clients be hedged against the US dollar?
Most of the currency exposure our clients have internationally is to US dollars, about 60, 70% thereabouts. The rest is in euro and a little UK pound. So when we think about whether to hedge international equity portfolios, it's usually in reference to movements in the Australian dollar versus the US dollar. The question we're asking ourselves here is what factors weigh on the Australian dollar and what factors will weigh on the US dollar? It's not clear to us which way that balance will shift. The Aussie dollar could move lower due to weaker global trade and specifically weaker Chinese growth. We could also build a scenario where the US dollar moves lower due to de-dollarization or a buyer's strike of US assets or weaker US growth forcing the Federal Reserve to cut interest rates. This is a different situation to what we had in March 2020 when COVID broke. Back then, it was clear that downward pressure would be placed on the US dollar because policy stimulus was going to drive the Aussie dollar up and the US Federal Reserve's quantitative easing was going to drive the US dollar down. We don't have that kind of setup this time, and so we're choosing to remain unhedged.
All right, thanks, Tracey, for those insights. That's all we have time for today. Hope everyone enjoyed the update, and we look forward to you joining us in a fortnight. In the meantime, please take care and stay safe. Thank you.
Thank you for listening to Escala Partners Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorised representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.